Look, here is what happened. Most people believe that investing in gold means either burying it in the backyard or dealing with an unknown coin dealer. But that has not worked. Not 2026. More than $5,000 an ounce. This is where gold landed this year, not the dusty brick and mortar bar in someone's basement. The real story is that ordinary investors like you and me have found something that has completely changed our view of metals, gold ETFs. We're talking about an investment that returned 64% in just 1 year. 64%. This number puts people in trouble, and I'm not here to tell you it is some kind of get-rich-quick plan. I'm here to tell you exactly what these things are, how they actually work, why gold has been crushing it, and whether they might belong to your portfolio. Stay, because at the end of the conversation, you'll understand what most of your peers don't know. What happened in 2025 tells us everything we need to know. The numbers aren't lying, and they're really impressive. Gold has become the main asset class with the highest annual return. We're not talking about technology stocks or cryptocurrencies here. The reason behind a commodity that has existed for thousands of years is crucial to understanding what will happen next. Geopolitical uncertainty played the biggest role. The Middle East remains unresolved. The South China Sea is heating up, trade tensions are real, and being an investor is not entirely peaceful. When things get murky on the world stage, money flows to what the financial world calls a safe haven: gold. Central banks around the world began buying heavily. Ordinary investors have followed suit, watching what institutions are doing and making their own moves. This geopolitical fear alone can explain about 12 percentage points of gold's total return by conservative estimates. Then, the dollar weakened. A weaker dollar makes gold cheaper for international buyers, boosting demand in Europe, Asia, and the Middle East. This dynamic contributed another 10 percentage points to the rate of return we saw last year. Here is what is interesting about what is happening now and how it separates it from every gold rally in the past 50 years. Much of the surge in gold prices comes from something that did not exist in any meaningful way. 2 decades ago, ETF flows. Pure investment demand is transmitted through a single mechanism. In 2025, gold demand in the United States increased by 144% year-on-year to 67.9 tons. Almost all the growth comes from ETF investment, not jewelry, not for industrial use. ETF investments. This year alone, $7.7 billion flowed into gold ETFs. That added more than 700 tons to funds that track gold. The old ways of investing in gold are dying. People stopped buying bars, dealing with coin dealers, and renting safes. They are clicking on a button on their brokerage account. This momentum continues into 2026, which means that gold prices exceeded $5,000 an ounce in January, up another 18% since that milestone. Before you think this is just an endless rise, there is no resistance. I will tell you directly. Major institutions like the World Gold Council are wary of extrapolating such performance into the future. But importantly, they are also saying something important. Gold still has real reasons to do well, especially in our environment. Now, let me talk about the real problem. What is a gold ETF? ETFs represent exchange-traded funds. And when you think about your money, I break it down in a meaningful way. Imagine the nightmare of owning a piece of gold without buying it yourself. Instead of buying a brick-and-mortar bar and figuring out how to store, insure, and eventually sell it, buy a stock in a fund that holds gold for you. The fund's whole job is simple and straightforward. Hold gold so that the fund's price is as close to gold as possible, consistent with commodities. When you buy shares in a gold ETF, you buy a small portion of the gold actually held by the fund and store it in a vault. The fund operates insurance. The fund is responsible for all logistics. Your job is to click on stocks, just as you did with Apple or Microsoft. Let me give you the most practical example, because it is important. GLD, the world's largest gold ETF, represents SPDR Gold Trust, and is managed by State Street, one of the world's largest financial institutions. At present, GLD actually holds about 900 tons of gold in the vault. If you own a stake in GLD, you actually have a percentage claim on gold, and you can verify yourself at any time. The price trend of GLD is almost completely synchronized with the price of gold, which means that when gold rises by $10 per ounce, GLD will rise accordingly. When gold falls, so does your investment. So straightforward and transparent. Compared with holding physical gold, there are 5 things that make this approach shine. The first is liquidity. During market times, you can buy or sell GLD in seconds. Try this with a 50-pound gold bar and see how hard it is. Second, there is no storage problem at all. You don't need a monthly safe or a family safe that requires insurance and constant fear of becoming a target. ETF handles all this for you. Third, there are no pure concerns. When you buy physical gold from traders, you believe that they are actually 9.9% pure. With an ETF, it is constantly reviewed and verified by independent parties. Fourth, reduce the startup cost. GLD is currently trading at about $200 to $210 a share, meaning you can buy a share directly. Try buying a gold bar yourself, and you'll see at least a few $1,000s in advance. Fifth, it is more important than people realize, completely transparent. Most gold ETFs disclose their holdings on a daily basis. You can see exactly what gold they own, where it is stored, and who holds it. Therefore, gold ETF is basically a solution for modern investors to hold gold without worrying about any trouble caused by physical commodities. Now, this is an interesting place because gold ETFs are not born equal. There are several different types, and understanding these differences can save you thousands of dollars in your investment career. These hold physical gold bars, the largest of which dominate the market. SPDR Gold Trust GLD is the heavyweight champion. It has the widest range of volatility, the highest one-day trading volume, and holds about $70 billion in assets. The rate, the amount you pay to own it each year, is 0.40%. If you invest $10,000, you pay $40 a year. It sounds cheap until you realize that substitutes are only half the price. EAU represents eShares Comics Gold Trust, which has essentially the same business as GLD but is managed by BlackRock rather than State Street. The rate drops to 0.19%, which means you pay $19 a year instead of $40 for the same $10,000 investment. The gap has widened significantly over the decades. With about 3.5 billion assets, IOU is the second most popular choice for investors. ETF Physical Swiss Gold Stock Skull stores gold in Switzerland, not London. The lowest cost rate was 0.17%. However, the size of assets is only 2 billion, which makes you smaller and less liquid when buying or selling large positions. SPDR Gold Minishares Trust GLDM is interesting because it is basically a mini version of GLD. At just 0.10%, it is one of the cheapest gold ETFs in the world. About $5 billion in assets means it still has ample liquidity for most investors. For long-term investors, the difference between 0.40% GLD and 0.10% GLDM has accumulated in surprising ways over time. If you hold it for 20 years and gold returns 3 to 4% a year, the difference can cost you thousands of dollars. However, GLD does provide more liquidity, which is important if you buy or sell too large a position to affect the market. The currencies themselves do not hold gold. Instead, they own stakes in companies that actually mine gold. Newmont, Agnico Eagle, Barrick Gold, etc. These companies pump gold out of the ground and sell it. Why would anyone buy mining stocks instead of physical gold? Because mining companies can magnify the trend of gold. If gold rises 10%, miners may rise 15% or even 20%. But that is a crucial part that nobody has mentioned. They may also fall faster. Physical gold remained relatively stable during the 2008 financial crisis, while mining stocks were completely crushed and never recovered for years. VanEck Gold Miners ETF GDX is a popular choice in this category. The company tracks about 50 large gold mining companies around the world at a cost of 0.5 -1%. This is an area of high risk and potential return, which is not what you want if you are looking for portfolio insurance. All this is worrying. They use derivatives leverage or bet on gold, and FGDL is worried because it has risen 49.66% over the past year, far exceeding conventional gold ETFs. But there is a problem that everyone ignores. Leverage is two-way, and in a falling market, it is harder to collapse. These are not investments held for 20 years. They are tactical bets that require active management and sustained attention. For 95%, a simple physical gold ETF like GLD, Iowa U, or GLDM is the right choice. Simple, transparent, and directly linked to the price of gold. You don't have to pay a premium for what you don't understand. Let me tell you, the reasons for the gold surge in 2025 have not disappeared. If anything, they have become more complex and urgent than before. Inflation has been stubborn from 2025 to 2026. The Fed wants inflation to reach 2%, but we have been seeing inflation above that target. Gold is one of the few assets in history to protect your purchasing power when inflation rises. For centuries, not just years, but also centuries of historical records, gold has maintained its value while the currency has depreciated. In 2025, this inflation hedge became a very attractive proposition for serious investors. This is the elephant no one in the room wants to acknowledge. We see that the situation in the Middle East has not yet been resolved and is brewing. Tensions are rising in the South China Sea, and shipping is crucial to global commerce. With the implementation of tariff policy, trade uncertainty under the new government, how the global alliance will change and reshape its own uncertainty in the coming years. Every geopolitical pressure point creates demand for gold as insurance. When Wall Street is nervous about geopolitical shocks, they buy gold. When ordinary people are nervous about what is happening around the world, they increasingly buy gold ETFs. The World Gold Council has found something notable. The council has a complex model of what actually drives gold prices. Geopolitical risk alone contributed about 8 percentage points to gold's 6.1% return in 2025. This is not a rounding error. This is a meaningful driver of returns. That is something people don't talk about enough. And in the long run, it is probably the most important factor. Central banks, the Federal Reserve, the European Central Bank, China's central bank, and India's central bank have been net buyers of gold for years. This is not a retail investor. This is the decision of institutions with trillions of assets that gold should be more allocated to reserves. Central banks bought 750 to 900 tons of gold in 2025. This is definitely a huge number, and the trend shows no signs of stopping, especially among emerging market central banks, which want to diversify their holdings of dollars and dollar-denominated assets. Real estate, commodities, and other real estate can resist inflation, but real estate sales take time, have transaction costs, and need to be actively managed. Gold is not. You can sell immediately through an ETF. That is why it is powerful. Data show that gold has a good history when inflation rises above 3%. Now we sit in that space. Not catastrophic inflation, but sticky inflation that makes cash deposits and low-yield bonds unattractive. Here are some important practical mechanisms in practice. When stock market volatility rises, money shifts to so-called safe assets. Treasuries are supposed to be safe, but with yields around 4%, they don't offer much return after adjusting for inflation. Gold offers not yields but portfolio insurance. When everything else is hit hard, gold tends to support and preserve capital. We see this again and again in recent history. When will the epidemic hit? In March 2020, Gold stabilized the portfolio. When will recession fears in 2022 make headlines? Gold is the most stable asset class. Last year, when people were really worried about a slowdown in the US economy, guess what people were pretending to do? Gold. Let me show you a real financial example of why people ages 35 to 60 should even care about this asset class. That is why boredom works best in practice. Gold is out of sync with stocks or bonds. In 2022, gold was positive when the S&P 500 index fell 18% and bonds fell even more. It is not luck or coincidence. This is the inherent mathematical irrelevance of the asset itself. Real Sharpe ratio analysis, a measure of risk-adjusted returns, shows that portfolios with 5% gold perform better on a risk-adjusted basis than portfolios without gold. You get similar returns, but less volatility throughout the year. It is neither flashy nor stimulating, but it is exactly what retirees need because protection is more important than growth. This is a disturbing fact that no one wants to hear. If inflation stays at 3–4%, the real return on conventional bonds and cash is almost zero, as widely expected. A 4% Treasury bond minus 3.5% inflation equals a real return of 0.5%. That is hardly anything. You're losing buying power. Gold has maintained its purchasing power for decades. You don't get a dividend, but your money doesn't evaporate into thin air. This distinction is important for people who are retiring or have already retired. Think of gold as portfolio insurance, and when you need it, you're actually using it. During a brief period of concern about the escalation of the situation between Russia and Ukraine in early 2025, gold soared immediately. Gold soared, again, amid tensions in China. The point is not that you want war or conflict. The point is that when you need gold most, the local political panic is high, everything else is falling, and gold is performing abnormally. Gold is up 64% from the beginning of last year and 18% so far in 2026. I've learned that when you look at these numbers, it is tempting. But here is what the experts really think. To be honest, the World Gold Council models different economic scenarios for 2026, and its framework provides us with a roadmap. In the basic case of consensus expectations, interval gold trading may be as high as 0.5%. Not exciting. In a shallow slowdown scenario, gold could rise 5 to 15%. The Federal Reserve cut interest rates, the dollar weakened, and risk aversion resumed. That is still good. In a doomsday cycle scenario involving a severe recession, gold could soar 15 to 30%. That is what insurance does. That is when you really want it. Gold could fall 5 to 20% in a reflation return scenario involving a strong economy. This is a risk that no one wants to admit. If the economy prospers, inflation remains low, and geopolitical tensions ease, gold will be hit. Consensus-based model results. It can be shallow. That means gold has legs, but it won't rise to $6,000 an ounce, at least not immediately. Here are some important psychological factors when you make portfolio decisions. If you hold zero gold, we will either slip or have an apocalyptic cycle, and then you will kick yourself. You will underperform investors ages 35 to 60, whose vision is to allocate 5 to 10% of your money to gold. If you hold too much gold, we get a reflation return scenario, and of course you lose some. But gold is insurance. Insurance makes you feel bad when you don't need it. Let's start tactics now, because the theory is good, but execution is really important. I'll tell you straight, if the investment is less than $25,000, buy GLDM. The interest rate is 0.10%, the cheapest mainstream option you can buy. Yes, GLD has more liquidity, but you won't notice the difference unless you trade thousands of shares a day. If you invest $25,000 to $100,000, I prefer IAGU. BlackRock has a handling fee of 0.19%, strong liquidity, 35 billion assets, and rock-solid infrastructure. It distinguishes between reducing costs and ensuring maximum liquidity. If you invest more than $100,000, you can choose either way. GLD if you think you are likely to sell large positions and want maximum liquidity. EAU if you worry about long-term costs dragging down your income. Don't use leverage and reverse ETFs unless you really know what you're doing. This is not an investment. It is a bet on your retirement. Here is what most people didn't realize before the tax season. For tax purposes, gold ETFs are treated differently from stocks. When you sell a gold ETF, your earnings are taxed as collectibles, meaning that long-term capital gains are capped at 28% instead of the 15% or 20% you pay for your shares. That is actually one reason gold is seen as more diversified than growth assets. According to a study by the World Gold Council, you don't want to be a millionaire on gold alone. You try to smooth out portfolio returns and guard against specific risks. This tax treatment doesn't matter at all in a Roth IRA or a traditional IRA. You can hold a gold ETF tax-free in a retirement account or a deferred income tax in a traditional account. This is the simplest part of excessive thinking. You log into your brokerage, whether it is Fidelity, Pioneer, Charles Schwab, or anyone you use. Enter the stock code GLD, EAU, or GLDM. You type in the number of shares you want, just like buying Apple or Microsoft. Click Execute. Done. That is it. Most brokers also let you buy points. If a stock sells for $200 and you want to invest only $50, you can buy 1/4 cent. There are no minimum orders, no special requirements. Complex methods include setting target configurations. Maybe you decide to take 7% of your portfolio. If your portfolio is $100,000, that is $7,000. Then, every 6 months or every year, you rebalance. If gold crushes it and now accounts for 11% of your portfolio, sell some. If gold has lagged, falling to 4%, you will buy more. This principle distinguishes successful investors from those who pursue performance and eventually sell at a low price. I need to treat legitimate criticism fairly here. There are real reasons not to invest actively in gold. A share, dividend. Bonds pay interest. Real estate generates rents. The gold is there. It produces nothing. If interest rates stay high, bonds will be more attractive than they are now. If the stock market is booming and AI stocks are crushing it, why tie capital to something that doesn't produce anything? That is fair. That is why I say 5% to 10%, not 50%. The real opportunity cost in 2026 is what else you can do with that money. If you really believe that AI will reshape everything and that S&P 500 technology stocks will triple, then yes, gold is boring and you should pass. But if you are 50 and you are making money and you are thinking about preservation rather than growth, opportunity costs have the opposite effect. You didn't do it. That is what you might lose. If the Fed suddenly decides to try to fight inflation and raise interest rates above 5%, the attractiveness of gold will be greatly reduced. Higher interest rates mean higher opportunity costs to hold non-yielding assets. If that happens, it could push gold down 10 to 20%. That is possible. Not basic, but certainly within reach. If the Trump administration's approach to trade negotiations really works, and we see a real easing of global tensions, it is deflation. Gold may be underperforming. This is not the crazy result of our invention. This is actually one of the scenarios announced by the World Gold Council. Here is what I think you should do, not what you have to do. I think that makes sense. For most people aged 35 to 60, it makes sense to allocate 5 to 7% to the physical gold ETF, not speculation, as diversification and insurance. That is about $5,000 to $7,000 per 100,000 portfolios. Buy once. Sit down and rebalance once a year. Do not trade based on daily price changes. I would choose IAU or GLDM. Both are effective and reliable. The difference is how much you care about cutting costs by a tenth. If you're in a taxable account, think about whether you want to hold it in Roth or in a traditional personal retirement account. Tax treatment is better. Anyway, gold is really bought and held. If geopolitical risks actually ease and inflation normalizes, you may reduce the size of your allocation. This is not immutable. This is a dynamic change over the years. Gold hit $5,000 an ounce for a reason. The structural forces driving its development: geopolitical uncertainty, central bank buying, inflation sustainability, and retail accessibility currently achieved through ETFs have not disappeared. But they could change. The world is changing, and so should your portfolio. Gold has nothing to do with getting rich. It sleeps at night, knowing that if the world gets weird economically and geopolitically, you have a safety net. Gold ETFs are the most practical way to get this exposure in 2026. And they make it so simple that there is really no reason not to consider it. That is insight. That is why everyone from pension funds to individual investors to central banks is increasing their positions. Not because gold is magic, because it works when you need it.